A covered call strategy combines a long position in an underlying asset with a short call option on the same asset. The primary investment objective is to generate additional income through option premiums while maintaining ownership of the underlying security. Investors typically employ this strategy when they have a neutral to moderately bullish outlook and do not expect significant price appreciation during the option's life. The premium received from selling the call provides immediate cash flow and partially offsets potential declines in the stock price. However, the strategy sacrifices a portion of the upside because gains above the strike price are effectively transferred to the option buyer at expiration. At expiration, the value and profit characteristics of a covered call depend on the relationship between the stock price and the option strike price. If the stock price remains below the strike, the option expires worthless and the investor retains both the stock and the premium received. If the stock rises above the strike, the call is exercised, requiring the investor to sell the stock at the strike price. Consequently, maximum profit occurs when the stock price reaches or exceeds the strike price. The premium enhances returns, while the break-even stock price is reduced by the premium received. The premium therefore provides limited downside protection but does not eliminate significant losses if the stock price falls substantially. The risk profile of a covered call differs significantly from that of an outright stock position. Although the premium cushions losses, the investor remains exposed to substantial downside risk because ownership of the stock is retained. Maximum loss occurs if the stock price falls to zero, though the premium reduces the magnitude of that loss. Unlike a long stock position, upside potential is capped at the strike price plus the premium received. Therefore, covered calls are most appropriate when investors seek incremental income rather than substantial capital appreciation. The strategy is frequently used by portfolio managers seeking to enhance yield in stable or moderately rising markets without materially altering underlying asset exposure. A protective put strategy combines ownership of an underlying asset with the purchase of a put option on that asset. The objective is to maintain upside participation while limiting downside risk. Investors often use protective puts when they remain bullish on the long-term prospects of a stock but are concerned about short-term uncertainty or potential market declines. The put option establishes a minimum selling price for the underlying asset, effectively functioning as portfolio insurance. While the strategy requires payment of an option premium, the investor gains protection against adverse price movements. This characteristic makes protective puts particularly attractive during periods of heightened uncertainty or anticipated market volatility. At expiration, the protective put creates a payoff profile that resembles an insured equity position. If the stock price rises, the investor participates fully in the appreciation, less the premium paid for the put. If the stock price falls below the strike price, losses are limited because gains on the put offset further declines in the stock. The maximum loss equals the difference between the initial stock price and the strike price, plus the premium paid for protection. The break-even stock price is increased by the premium cost. Therefore, the investor exchanges a known insurance expense for a significant reduction in downside risk exposure. The risk-return characteristics of a protective put contrast sharply with those of a covered call. Whereas a covered call sacrifices upside potential in exchange for income, a protective put preserves upside potential while requiring an upfront premium payment. Maximum profit remains theoretically unlimited because the investor continues to own the stock. Maximum loss, however, becomes finite and predetermined. This asymmetry makes protective puts particularly suitable for investors who wish to maintain long exposure while establishing a risk floor. Portfolio managers frequently employ the strategy to protect concentrated stock positions, preserve gains after significant appreciation, or reduce downside exposure during uncertain economic environments. From a portfolio management perspective, covered calls and protective puts represent opposite approaches to modifying equity exposure. Covered calls generate income and slightly reduce portfolio risk by selling upside potential, whereas protective puts increase costs in exchange for downside protection. The choice between the two depends on market expectations, risk tolerance, and investment objectives. Investors expecting limited price appreciation often prefer covered calls because premium income can enhance returns. Conversely, investors anticipating volatility or downside risk while maintaining a positive long-term outlook frequently select protective puts. Understanding these differing objectives is essential for selecting the most appropriate option strategy within a broader portfolio framework. For candidates, covered calls and protective puts are foundational option strategies because they illustrate how derivatives alter risk and return characteristics without eliminating underlying asset exposure. Covered calls demonstrate the trade-off between income generation and capped upside, while protective puts demonstrate the value of downside insurance and risk management. Both strategies require careful evaluation of value at expiration, profit at expiration, maximum profit, maximum loss, and break-even prices. Mastery of these concepts enables candidates to evaluate more complex option combinations, understand portfolio hedging applications, and recommend strategies consistent with investor objectives. These principles form an important component of derivatives-based portfolio management and risk control.